Welcome to the Pro Ticker Deep Dive. We're tackling a real financial riddle today. It's one that really challenges the whole narrative of stability we're hearing about in the banking sector.
Mm.
You look at the headlines, and everything just seems to be booming. Returns on equity are in the double digits. Loan losses look fine. The system appears incredibly strong.
And that narrative is exactly what we need to question here.
Uh-huh.
Our mission today is to look right underneath those polished earnings reports. Because the very things driving this profitability, these tight credit spreads, the incredibly low loss provisions, this whole atmosphere of complacency,
Right.
it's the same setup that has come before almost every single major financial crisis in history.
Mm-hmm.
We have to ask, are we just looking at a credibility crisis masquerading as a boom?
That distinction is everything. And when we talk about this boom, we're talking about serious profitability. Returns on equity hit 11.7% in 2024.
And they're expected to stay stable through 2025.
So what's the single biggest contradiction hiding under those numbers?
It's the sheer denial of risk in the market. I mean, when we look at how credit risk is being priced, especially for things like high-yield bonds,
Okay.
the spreads are trading in the second percentile of their 20-year history.
Okay, so second percentile. Help me picture that. What does that actually mean in real terms?
Think of it like a weather forecast.
Yeah.
If the chance of a hurricane is in the second percentile, the market is basically saying there's almost no storm coming.
So profound complacency.
Exactly. It's historically rare. The system is pricing risk as if all the uncertainty has just vanished.
Got it. So the key insight for you, the listener, is that this profitability isn't robust because risk is gone. It's robust because risk is being, systematically underpriced, delayed.
Underpriced, delayed, and hidden in plain sight. The credit cycle is showing what some are calling architectural cracks.
So the question is, how reliable are the foundations of that profit?
That's the one.
All right, let's start with the first fragile pillar, net interest margins, or NIMs. We saw some modest margin stability in the first half of 2025.
We did. The industry-wide average held at about 3.26%. Community banks did even better at 3.62%.
And that was mostly because they were very disciplined, almost aggressive about managing deposit costs, right?
And this is where that short-term win hits a long-term wall. Banks did a great job keeping those costs down, but that benefit has a very clear shelf life.
Why is that?
Well, we're already seeing the Federal Reserve moving into an easing cycle. We're expecting more rate cuts late in 2025 and into 2026.
And what happens when the Fed starts cutting rates?
The yield curve flattens. And this is critical. Consumer behavior has permanently changed. Depositors are way more price sensitive now. They expect good rates on their savings.
So as market rates fall,
The margin on assets drops faster than the margin on liabilities. So NIM compression is coming. And it could be steep. That profit source is already starting to evaporate.
so that stability is really just borrowed time. This brings us to the provision paradox, which I think is just fascinating. It seems like it's actively inflating profits right now.
It is. The paradox is simple. Banks look profitable today because they haven't set aside enough money for the losses that we know are on the horizon.
They're benefiting from exceptionally low provisions for credit losses.
Exactly. When your provision expenses are low, your reported earnings look high. It's like borrowing profit from the future.
And did we see any move to build up those reserves recently?
Barely. And the reason's very telling. There was a small increase in Q2 2025, but it was basically just an accounting event.
How so?
It was tied to a huge financial acquisition that quarter. It wasn't because banks were seeing organic credit problems across the system and preparing for them.
Which means the whole system is still running on these incredibly optimistic assumptions about defaults.
And that optimism translates directly into loose lending. You can see it in the underwriting standards across the board.
Right, the risk tolerance.
It has just exploded. We mentioned the credit spreads, high-yield bonds implying maybe a 1% to 2% default rate.
When historically it's more like, 3.5?
Closer to 3.5%, yeah. So we're operating in this state of collective denial about where default rates are actually going to end up.
And the power has just completely shifted to the borrower, hasn't it?
Absolutely. You see it with the widespread use of covenant-light structures in the leveraged loan market.
So lenders are giving up their protections.
They're giving up the ability to step in early if a company starts to get into trouble. And it's not just corporations, it's happening in consumer lending too.
Give us a specific consumer example. I'm seeing a metric here on mortgages.
Look at mortgages, yeah. Nearly 10%, 9.7% to be exact, of new mortgages are at a loan-to-income ratio, or LTI, of 4.5 or even higher.
So for anyone who doesn't deal with mortgage data every day, what does an LTI of 4.5 really mean for a borrower?
It means their total annual debt payments are 4.5 times their annual income. Historically, those limits were much tighter, around 3.5 or 4.0.
And now nearly 1 in 10 new mortgages are above that.
Right. It means lenders are stretching to find business, taking on borrowers with less of a financial cushion and making the whole system much more sensitive to even a small shock in the job market.
So if the big picture is hiding risk and underwriting is stretching, where do we see the pressure first? Let's talk about the systemic hotspots, starting with commercial real estate.
The CRE challenge. It's not just a problem, it's a systemic maturity wall. We are looking at $957 billion in CRE loans maturing in 2025 alone.
Almost $1 trillion.
It's nearly triple the 20-year average. Think of it as this massive logjam of debt that's all going to hit the refinancing market at the exact same time.
And if they can't refinance?
Then you get forced sellers and immediate capital pressure on the banks.
And this isn't a cyclical dip, is it? It's structural, especially in office space.
Precisely. Office vacancy rates are averaging 19.4% nationally. This isn't just because rates are high. This is a fundamental change in how people work.
So the gap between the loan amount and the property's real value is just getting wider.
It's widening rapidly. And this also shows how risk has already been pushed outside of the traditional banks.
How do you mean?
Well, the traditional banks look okay on the surface. Their CRE delinquency rate is only 1.57%.
Which sounds low.
But then you look at the commercial mortgage-backed securities market, the CMBS market.
Yeah.
Their delinquency rates have already hit 7.29%.
Wow. That is nearly 6 times higher.
It's a huge divergence. And it gets even worse when you look at the alternative lenders, the ones who funded the riskier deals.
Okay.
They're already seeing defaults over 20% in some of their portfolios. The risk didn't go away, it just moved into the shadow banking system.
Less regulated, and when it breaks?
It breaks faster, and the shock waves travel just as easily.
And moving from commercial to consumers, the household debt alarm is also ringing pretty loudly. A record $18.59 trillion in Q3 2025.
And we're seeing a very sharp acceleration in serious delinquencies. The number of people transitioning into serious delinquency jumped to 3.03% in the third quarter.
And what was it a year ago?
It was 1.68%. So it's almost doubled in just 1 year.
What's really important here is the type of debt that's under stress. It's not mostly mortgages, is it?
No, not at all. The stress is shifting hard towards unsecured and subprime lending. So credit cards, auto loans, student loans.
And those are more dangerous right now.
Much more. They have higher loss severity, the bank loses more, and their default cycles are way faster than mortgages. As the labor market softens, and we know the Fed expects it to, these are the very first dominoes that will fall.
Okay, so we have rising risks.
It is. It tells you that the sophisticated money is already looking past the current headline earnings. They're pricing in the margin pressure. They're anticipating the reserve builds.
They're getting out now before the bad news really hits the balance sheets.
They're taking their chips off the table.
And the broader macro context seems to support that defensive move. The Fed's easing cycle, those rate cuts we talked about, that's not a sign of economic strength, is it?
Absolutely not. The analysis suggests this is a defensive move. It's being driven by a deteriorating labor market and a lot of policy uncertainty, especially around the tariffs announced back in April.
So the stability is fragile.
Incredibly fragile and very politically sensitive.
Let's circle back to that interconnected risk. You mentioned that traditional banks look well capitalized. Tier 1 ratios are around 14.27%. Does that mean the system is safe, even if the shadow banking system breaks?
Well, that capital is a buffer, for sure. But the financial system is a web. When credit spreads widen out sharply, the value of instruments like collateralized loan obligations just plummets.
And who holds those?
Pension funds, insurance companies, and the biggest traditional banks, often through their investment arms. So a shock that starts in private credit can transmit very, very quickly to traditional balance sheets. It hits liquidity and confidence almost instantly.
Which means this compression of credit spreads happening despite all these deteriorating fundamentals, it's creating a dangerous setup.
It's a classic setup for a rapid, and I mean violent, reversal. And here is the single most important warning flag that I think most people misunderstand.
What's that?
The non-performing loan ratio. It's exceptionally low right now, 1.04%. Most people see that and think, great, defaults are low.
But history shows that NPLs are a lagging indicator, a huge lagging indicator.
Precisely. The NPL ratio only starts to climb 6 to 12 months after the real economic stress has already started. That low number isn't a clean bill of health. It just means the bill hasn't come due yet.
All right, let's play devil's advocate. Let's look at the contrarian view. Is there a bullish case to be made here? A scenario where the optimism is justified?
There is a valid one, yes. I mean, capital markets activity did rebound in 2025, which helps investment banking. And banks are still incredible deposit gatherers, with almost $13 trillion in mortgages alone.
So if the labor market stabilizes,
If the labor market stabilizes and corporate fundamentals somehow hold up, then maybe, just maybe, those tight spreads could be sustained.
but what is the core risk scenario that really outweighs those bullish points?
It's simply a normalization of corporate defaults. If default rates just go back to their historical averages, say 3.5 to 4% spreads will widen dramatically.
And that forces an immediate, massive reserve build.
Massive. Combine that with the CRE maturity wall forcing asset sales, and the capital pressure becomes, well, existential for some institutions. The data shows 278 banks are vulnerable to just an 8% loss in CRE. That is not an acceptable level of risk.
So what is the final bottom line take of it for you, listening right now, trying to make sense of all this?
The final truth is that the current profit levels are unsustainable. You should expect a sharp shift in where bank earnings come from. Investment banking will be less reliable, NIMs will compress, and credit provisions are going to have to surge.
Which pushes returns down.
Our analysis suggests that for many banks, return on equity is heading back down towards single digits. Those tight spreads you see today are not a clean bill of health, they are a warning sign.
It's the lesson the market seems to forget over and over again. The credit cycle cracks at the edges long before the center collapses. The current tight spreads are just mispriced risk.
That's it in a nutshell.
And the valuation discount that conservative investors are waiting for. It may not show up for another 18 months, but the foundation for that correction is being built right now.
It certainly is.
See you all in the next Pro Ticker Deep Dive.